Okay, we'll make a start. Good afternoon and welcome everyone to today's webinar on what super changes are expected in 2022. My name is Daniel Tramontana and I'll be just hosting today's session for Jason Roccasalvo. Is that right, Jason?
Spot on, Daniel. Spot on. Thank you.
Only an Italian could pronounce that first shot.
That's it.
Look, we just want to firstly thank you, Jason, for hosting today. And we know that the SMSF space is one that really does change a lot, and the changes come through thick and fast. And today we've got the ability to listen in, Jason, on what will probably take place in the coming months or even the coming years, but more importantly, what the 2021 federal announcements were, what the state of play is in regards to the previous federal budget announcements and where we're at with some of those important developments that took place. And then also some of the ESA changes and the impacts they have on the clients and also the trustees. And so I know that Jason and their team are an incredible group of people. We've had a strong association with TAG for over 20 years. We see them as a great friend and authority in the space, and they've been behind things like our audit work papers for a long time. They've been users of our software for a long time. So we know that we're putting before you a quality person in Jason, backed by a quality business. And I'm sure you're going to love today's session. A couple of housekeeping things. The slides will be available at the end of the presentation. During the presentation, feel free to ask questions. I'll be moderating those, and if I can ask them of Jason during the presentation, I will. If not, I will wait until the end, and then we'll go through those questions. So Jason, I'm going to hand it over to you. Welcome, and thank you for taking the time to do this for us.
Fantastic. Thanks very much, Daniel. One of the things, just as I'm getting this started, so hopefully now you can see the slides there in front of you. One of the big ethoses that we have here at TAG is about turning the technical into practical. So while we'll go through a number of these topics today and just look at their actual implications and what the rules are, what they're changing to, or what they're proposed to, I really want to try and maintain a concept or a mindset about how it actually is going to work and affect us, I guess, as advisors and affecting our clients as well. See the disclaimer there. Obviously, everything in here is general in nature. It's not personal advice in any way, shape, or form. As Daniel said, so we're going to be covering off the last couple of federal budgets, and then obviously the ESA changes that have come through. We've been in play for a couple of months, but just some of the practicalities and flow-on effects that we're sort of seeing in practice these days. One of the positive changes that we saw being announced in the federal budget was of last year was the increase of age in the removal of the work test all the way through to age 75. We see that as a really positive change for a number of older Australians, obviously, that have retired, that may not have necessarily had as much opportunity to build up their retirement wealth. Obviously, retirees have capacity under things like downsizers to have previously made a contribution. But really, for those aged 67 and 65 as of about 15 months ago or 18 months ago, you really had to meet a work test before you could add towards your super. So what we're seeing here with this proposed change, it's in front of Parliament. Parliament only came back yesterday. I believe we've got about 2 weeks worth of Parliament sittings as well before the expected or the due date for the federal budget for 2022. So fingers crossed with this being in front of Parliament, they sit down and actually legislate some things over these next couple of weeks. But looking at this change here, it only applies the removal of the work test up to age 75, as I said, to non-concessional contributions only. So if you have retirees or if you have older clients who are looking to make contributions and say looking to make a personal tax deductible contribution, they still need to meet a work test to enable them to make a concessional contribution. So where do we see this applying well in practice? As I said, you've got retirees that may not have had the opportunity to build up their wealth. You could have your clients looking to use this non-concessional freedom, I'll say, in conjunction with things like the downsizer contribution to really boost their retirement wealth. Also, we do see the application here or an extended application from what we've currently got around concepts like withdrawal and recontribution strategies. So, if we've got a larger window, typically those strategies get employed between the ages of 60 and 65 because clients have the ability to withdraw tax-free. So we don't have that impact on a personal tax side. But the recontribution strategy is really probably the most powerful tax planning strategy and longer term strategy we've got with our SMSF clients, purely because it is saving, obviously, it's not necessarily saving them any money, it's saving their beneficiaries money. But it really is a powerful strategy, and putting that in front of pretty much every client that I speak to, they like the idea, they like the concept of being able to save tax. Equally as well, we have uncertainty with, perhaps a change in government. We have uncertainty over the coming years about how our federal government's going to be able to contain budget deficits and shortfalls. It may only be a matter of time before the changes that came in 2007, where payments from super to retirees became tax-free for over 60s, may only be a matter of time before that gets repealed. So if we're in a situation where we can work with our clients for a longer term strategic benefit and also insulate them personally from any potential legislative change, I think that's a really positive change that we can make and we can work with our clients on. As announced in the federal budget, the proposed commencement date for this aspect of the legislation isn't until the 1st of July 2022 anyway. But yeah, if we have a federal government change, we may not have this announcement ever see the light of day. As I said, the personal concessional contributions, we still need that work test to be met. So the 40 hours in a 30-day period. And as well, the contribution has to be made before turning age 75. Okay. I touched on this before, just very, very briefly in terms of our clients and building their retirement wealth, but the downsizer contribution, so that came in a few years ago now, has been in operation for those individuals aged over 65. Again, the proposal there, again, from 1 July 22, reduced the eligibility there to all individuals aged 60 and over. All the other eligibility criteria is still the same, so there's no changes there, which is pleasing. Is expanding the age opportunity there for individuals. This one's always been an interesting one. I'm not sure how for you guys out there in the marketplace with your clients, how this has been received, but I often find clients that are open to selling their house and actually downsizing. Might be a downsize in floor space, but definitely an upsize in price often is the way that they go. So there's not a lot of money left behind when clients look to sell their houses. Having said that, downsize is still obviously a very popular opportunity for clients in the circumstances where we've got the right mix. The other advantage of the downsizer contribution is we aren't constrained by the normal balance cap, transfer balance cap and total super balance constraints that we would on a traditional non-concessional contribution. So clients could have $3 million in super, they could be 60 years old, they could have sold a main residence that they've otherwise owned for 10 years and still be eligible to contribute $300,000 as a downsizer for themselves and their spouse as well. So obviously still a very popular tool, but it needs to be probably in a real holistic sense be considered in amongst a number of factors, because we can't use the downsizer contribution to get extra access under the transfer balance cap. You're still constrained to the 1.7 million or the adjusted transfer balance caps for those that are in a transitional sort of phase. But a very, very popular strategy, a great idea, but we all need a roof over our heads, so it should be tempered with a grain of salt. The intention, though, clearly from the government is to try and release some of the equity individuals have in their own homes as they work through retirement, and have them try and use some of that money as opposed to large house on an aged pension sort of concept that tends to get a lot of the news. This is a really popular, again, not yet tabled, or it wasn't yet tabled when I'd put all these slides together, but a fantastic announcement that I'd heard and that we'd seen in the federal budget from last year was around the conversion or a grace period around legacy pensions. So it doesn't include flexi pensions, but the non-commutable pensions, where the proposal was to have a 2-year amnesty to let people out of those legacy pensions where there otherwise is no ability to commute them under the current law that governs those pensions. So not yet tabled when it was written. Again, to be proposed to be tabled from the 1st of July. But where we see this popular is, we do, I'm sure everyone does as well, have a number of clients where they may have entered these, lifetime complying pensions, 2003, 2004, we're talking almost 20 years ago now, and done so under the old RBL, done so for Centrelink purposes. And just through the nature of time, those balances under those pensions have reduced to such a point where maintaining a self-managed fund isn't really practical from a cost-benefit perspective. However, you've still got these constraints around these pensions. So the announcement here is quite popular. We do need to see, obviously, the proof in the pudding, and we do need to see that it gets legislated. But I think if it does get legislated, then it's going to be a really popular thing to engage with your clients around, because for lack of a better term, some clients might be trapped using a self-managed fund. Yes, there are other alternatives. You can obviously roll a complying pension into another complying pension, or an annuity, but from those, they contain somewhat similar limitations. So we'll see what the proof is there, but I do obviously hope that no matter who's in power, that gets legislated, because it'll be very useful, and it would save costs particularly for those clients where, all other factors considered, the size of their fund, the types of assets they've got, their age profile, that may not be appropriate. So again, we wait and see on this one, but I really hope that this does get legislated for their benefits only. Whether you're a financial planner or not, you should always be bound by the best interests for clients. This is one where sometimes the law is really constraining us around what their best interest might be. Looking through to going back another 12 months, so I touched on it with the proposal to increase everything through to age 75, but we do have that 2-year extra window now where the access to bring forward non-concessionals, it aligns with the increase in the work tests. So instead of us living in a world where clients age 65 and over had to meet a work test, we're now in a world where we can bump that up to those aged 67 and over, and they need to meet a work test. Probably the key thing here is the work test is looked at the time you're making the contribution. So if we've got a client who is turning 67 tomorrow and they're not going to meet a work test, then we need them to get their money in today to be able to qualify and satisfy the law as it stands. So that's the law as it stands now. So I see an extension up from 65 through to 67. As I said, aligning with the increases in the work test, it's aligning better with pension ages and those sorts of things. It's been in play now for about 8 months that this has been in play. But again, we do have a small window where obviously 65 and 66-year-olds can take advantage, but those who are already aged 67 through to age 74 are currently still in limbo with the more recent 2021 work test extensions. So a small step forward in a positive manner. Again, where can this be of use without the need for the work test? It's probably most commonly around things like, again, around recontribution strategies, because I dare say a lot of planning would have been done prior to age 65 if they'd already been retired. But recontribution strategies may extend our usefulness, our lifespan, our ability to whittle away larger taxable components of members' balances and just boost their tax-free components, particularly as they start a pension where we're locking in those things in a percentage sense rather than a hard dollar sense as well. Looking through, so again, a number of years ago now, this was proposed in the federal budget. It sort of hit the back burners, then gained some more steam, but obviously from the 1st of July, of 2021, we've now got 6 member funds that are available and on the table. BGL's obviously been putting in a lot of work, and a lot of trust deed providers have been putting in a lot of work, as has the ATO, to make sure that their systems are capable of registering up from 4 to 6 trustees and members. But really see this as a positive change. It's probably a step in the right direction if we're looking at an SMSF and considering SMSFs as more of I guess a whole of family experience. We do have a number of clients that might have self-managed funds where it's husband, wife, and a child, and they've got 3 or 4 of those because they've got 4 kids, or they might be running a separate fund with the 4 kids in one fund and mum and dad in the other. So from that standpoint, it's a really positive change. It obviously increases the number of members, which increases potentially the number of people contributing. So it's positive for cash flow, particularly again where you've got that intergenerational mix of members in the fund. So you might have, the 4 kids, 2 kids, 2 in-laws, and then the mum and dad are retired. You've got the contributions all coming in, which is again helping to cash flow, say, pension needs from the parents. But it probably allows self-managed funds to look at some things or balance what otherwise would be an otherwise illiquid portfolio with that liquidity of the younger generation being able to contribute. Really seeing the 6-member fund is quite a positive tool, particularly where you've got the family business. You might have a business premises. We've got a bit more certainty around contributions, employment, those sorts of things. You've got the rent coming through. Does allow a larger asset, does open the door for obviously more contributors, means more cash flow, might in a family business sense open the avenues for more funds to be able to entertain things like borrowing in super to fund a business premises. So it's a really positive change. As I said, it really does require as well the trust deed to be analysed and made sure that 6 trustees, 6 members can be catered for within the terms of the deed. A lot of trust deed providers have spent significant time, especially since Royal Assent in late June, in getting their deeds up to date to cater for this. As I said, the ATO's got their systems up to date, which is really important as well. But then really it's then on, obviously, getting the clients on board, getting the clients understanding the pros and the cons. So, I've spent a bit of time looking at the pros of the 6-member funds, but when you've got 4 kids all at a different stage in life, perhaps mum and dad at different stages, or more of that intergenerational mix, it does create questions or add more questions to things like the investment strategy of the fund. What's appropriate for the elder members and the retired members may not be as appropriate for the children. Then you've got more members, more risk profiles, and more considerations you've got to look at there as well. So it does add to complexity, but it will add to opportunity, again, particularly for family businesses. Where I can see this as well, not only in a business sense, but also, again, in that illiquid asset sense, is that, you might have a position over time where the mum and dad are withdrawing money that's less than what the other members are contributing. So in a ratio sense, the younger members are slowly building a larger ratio of the fund while the parents are drawing that down. And that's really going to be something that's quite useful when we're considering illiquidity of fund assets in light of having to pay something like a death benefit out. It does create complexity, again, especially if you've got, in-laws, son or daughter-in-law. If there's a marital issue, you've got to unbundle assets. It's perhaps entangling the parents. It's not putting the parents' wealth in jeopardy in terms of the superannuation, but it might create complexity when we're dealing with those illiquid assets that probably just needs to be considered. And like a lot of these things, it's just about engaging your clients in a timely manner and knowing what's potentially suitable and giving them the full pro and con assessment, because if they don't know the risks, then they can't understand the rewards. Some of the other updates that we've that we've looked at, obviously pension minimums are still reduced, so no word there as yet on whether that's going to extend into the 21-22 financial year. My expectation, and from what I hear, is that that's going to go back to normal. So particularly for our clients that have got a mix of fund that doesn't have as much cash in it, this pension minimum has been being reduced has been quite a godsend. It has allowed clients to maintain larger cash balances in their fund that they otherwise might not have been able to maintain. That's really quite a positive thing. Again, it's about the communication. So some clients are just taking the amounts out that they otherwise would have, which is all well and good if they have a need to spend it. But if it's a habit, if it's a direct debit and they're just sticking to their traditional 5% or 4% or whatever it may be, really important to engage with them around opportunities to reduce it and still obviously comply with the legislation. So I had a client the other day who has a significant superannuation retirement balance. Their pension minimum, husband and wife combined, at the 2.5% was a bit over 100 grand a year. Their fund only had 110 grand in cash in it at 30 June. So again, significant assets and liquid assets that they could sell, but just being proactive with your clients around considering their cash flow needs, particularly now in not only in times where it's reduced, but looking at if this is going to go back up to $200,000 a year, how is your fund going to be able to cash flow that $200,000 worth of pension payments? It's a really important thing to discuss with your clients on a regular basis because their expectations and their needs may be a little bit misaligned. It may require a sell down of assets at an undesirable time. Consider that in the mix of volatile assets. If you've got clients that have got decent shares of their portfolio in things like cryptocurrencies, which are highly volatile, if they've got to sell down to meet a pension minimum, there's clearly good times and bad times to do that. But it's just worth considering that and discussing that with clients. So obviously, you've got to consider that in light of being their advisor and towing the line between general and personal advice. But if you're unable to provide it yourself, it's very important that they get that help, that guidance somewhere, because what I fear we're going to see post 30 June of 2022 is cash flow shortages in self-managed funds and people that are being forced to sell assets when, with a bit of planning and forethought, they might have been able to manage things a little bit better. Being able to sell at a position of strength rather than a position of need is really important. And again, it's easier said than done when we're talking about, a portfolio that might predominantly be shares. But if you consider your clients that have low cash balances but have significant portions of their fund that are in property, this is going to be an even more important discussion because property yields somewhat are capped. But if you've got residential property, they're obviously for the most part going to be net yields that are less than the annual pension minimum. So just considering all your clients' needs, I think, is quite an important thing to balance their cash flow needs, because the last thing they need to do is remove assets, sell assets at the wrong time. The other discussion with the reduction in pension minimums that I think we're going to see more and more of is clients perhaps not having as much of their fund or as much of their balance in pension mode as they otherwise would see fit. I mean, typically we've got clients that want to maximise how much they have in pension mode, so using the entire transfer balance cap. What I think we're going to see more of is clients that might be more accustomed to perhaps spending less or needing less from their super funds. So there's definitely going to be a mix of clients that more and more will reduce the need or reduce the size of their pension balances as a proportion of their total balances, and more aligning the size of their pension probably with where they see their spending, their lifestyle goals and objectives and needs are taking them. So that client I had before that in a traditional year at 5% would need to take out $200,000 out of their fund. If they're happy only living off $100,000 a year, as an example, they may consider cutting their pensions in half, so their minimum pension is only $100,000 a year. if they're just building up assets outside of super that's going to start getting taxed at their marginal tax rates, is that really going to be the best thing for them? They're the sorts of things that I think we're going to see more and more of, irrespective of how legislation goes. They're the sorts of things I think we'll see more and more of, and should be looking to have more discussion and engagement with our clients around as well. Obviously, as well, we're only talking about pensions here in the context of account-based pensions. You've got clients that have got pensions in other funds and other mixes as well that will come into the equation. A lot of that correspondence and a lot of that data obviously is maintained by the ATO at the individual level. So I think it's really important, again, to engage with clients, particularly where you're not the tax agent, to engage with clients and have at least see what the ATO have from things like their MyGov or via their tax agent around their transfer balance cap sizes and around contributions, their ability to trigger things like carry forward of contributions and bring forward of non-concessional contributions as well. So looking at all that mix from an individual sense with what the ATO data has, not just looking at it from an SMSF sense. Another change, so the exempt current pension income, still under consultation. So there were budget announcements back about 3 years ago, which were looking to simplify and reduce the red tape around exempt current pension income and the need for actuarial certificates. Anything that can simplify the system around that, I think, is going to be a positive thing. There's talk of announcements around different taxing points and things like that. And obviously there'll be a lot of lobbying and things for not only for both sides of Parliament in a lead into an election around how superannuation should be perhaps changed or altered to be more equitable. But just things like exempt current pension income and the need for actuarial certificates, anything to simplify the system, I think is a very, very welcome change. We're still waiting to see how that looks. I speak from my team's experience because I don't do it myself, but I speak from my team's experience. The seamlessness and the integration through BGL with actuarial certificate providers is fantastic. The guys love how easy it works, how quick it works, how quick obviously we get the information back, and how it just automates its way back through BGL's system as well. So that all works fantastically. Anything that can further simplify the system, I think, is a really positive change to the system as well, because I think, again, that's where we can get some uncertainties. You can get some, obviously, gaming of the system if you've got the fund fully in pension mode for a defined period of time, and then we can focus on segregation fully during that period of time. You have circumstances where you're able to then, have a large, otherwise taxable event be considered and gamed into a circumstance where we've got a larger exempt current pension income or a fully exempt period for the fund for a part of the year. So being able to run those nuances through the system adds complexity, adds opportunity, but I think simplification, particularly around this, would work the best from my perspective. As I said, so removing the ability to get an actual certificate where we're talking about 100% in pension phase, it presents cost savings, which simplifies things. Obviously, is better for clients, better for ourselves, not necessarily better for actuaries, but presents cost savings. But I think with that, it presents opportunity to simplify, which will have a lot more cost saving effect for us as advisors. Probably one of the other things, as Daniel sort of spoke about as well, we've got the super stream changes that the extra changes that came through on the 1st of October. So we've been operational now for 4.5 odd months in this new world of, 3-day turnarounds, particularly on things like rollovers. So having that 3-day turnaround, from our perspective, we've seen it work quite well, and we've seen it work quite confoundingly. But really, we've got to look at how we as advisors can really probably properly leverage the capabilities of systems like BGL to our advantage and for our clients' advantage, because our ability to handle things in a timely manner here is obviously quite hamstrung by how effectively we're using things like BGL, how real-time our data can be. It can work quite easily if we're only looking to process a rollover of a finite amount of an otherwise larger component of a member's balance. It is a bit easier to manage those things when we're not dealing with as real-time a collection of data. But one of the things I think we really need to look and turn our attention towards is having that real-time availability of data. That's the one thing that these changes really scream at me about, is how can we, obviously as advisors, make as much hay as the sun shines on things like BGL systems. So data feeds for cash accounts, portfolio accounts, getting authorities from the client that may not necessarily feed into BGL, but gets information sent directly to us as opposed to via the client. And really just our overall engagement with clients really needs to be upped to be able to have their funds cater for and handle the system that the ATO's now got in place. One of the things I really look at with this 3-day turnaround, we've seen examples of, in a practical sense, of funds being set up, managing clients' expectations around ABN applications and the ABN being received, because that obviously can slow things down from receiving the ABN. We won't be able to obviously register for SuperStream. We won't be able to get a bank account open, which is important as well. And then obviously the rollover fund won't be able to see that the SMSF exists. So having the ABN is vital from those three perspectives. One of the things that we're seeing here as well, which I've got a slide a bit later on, is consistency of data is really vital. So we've seen circumstances where the members' details, the personal details with the ATO, have a middle name. Data in BGL has a middle name. So the ATO's records in terms of the ABR has the super fund with the individual's full name with middle name, but their existing fund doesn't have a middle name. The data now doesn't match, and the SuperStream request gets delayed or obviously denied. So really it's about consistency of data from the existing fund, from the self-managed fund, and from what the ATO has on the tax agent's portal for the individual and for the superannuation fund as well. So tax agent portal and ABR. You really need to make sure you've got consistency of data across all of those features to give yourself the best chance of a rollover coming into the fund as seamlessly as possible. Equally, as money goes out of the fund, obviously the self-managed fund still needs to comply with that 3-day turnaround. It is something that does carry with it and brings with it audit issues if you don't comply with it. So we've got potential audit issues if we've got funds that aren't complying or self-managed funds not complying with that 3-day turnaround. So it's probably a massive opportunity or a massive impetus to make sure that as advisors, as tax agents, we've got consistency of data through all our systems where otherwise we might have perhaps had the opportunity to be a bit lax. That extends to things like bank accounts, being informed and up to date with clients when they close a bank account, open a new bank account, so on and so forth. Got a circumstance where I had an accountant call me the other day where they've got a client who has a self-managed fund, wants to set up another self-managed fund, and he's just going to write themselves a check, or has told the accountant he's just writing himself a check for the rollover. I'm like, well, you're not following the SuperStream payment standards there. You get a unique reference that needs to be used. Obviously, the ESA needs to be able to cater for rollovers through SuperStream. I think initially there were a couple of SuperStream providers whose ESAs didn't cater for it, and that was probably one of the impetuses for BGL to go and get their own, which has catered for it since the start of October. So there's a number of factors you need to get. Really important just to have your clients be aware that if they're looking to do a rollover, that's fantastic. They need to work with you and act when you tell them to act, to make sure that their fund meets the payment standards that it needs to satisfy. We look at the ESA use, as I said. So the ESA use there, we've got three components there. We're talking about SuperStream, obviously, which is a contribution recipient one. We're looking at rollovers, both in or out of the self-managed fund. And then also we're looking at things like ATO releases, like Div 293 assessments and those sorts of things. So again, another change to things like the Div 293 system. It's all about communication with your clients. As I said, data doesn't match is a massive thing that we're seeing delaying, particularly on rollovers, delaying the processing of a rollover, whether it's out to the fund, out to another fund, or into the self-managed fund. So consistency of data between all those sources is just really, really important. Probably one of the things that's sort of flying under the radar with all of this is that the ESA is obviously attached to the fund. Now, the ESA really is driven by an ABN, as I said before. So if you've got clients who are otherwise late lodging, so they've got outstanding tax returns still for 2020 or 2020 and 2021 at this stage, there's a almost 100% chance that if you look them up on Superfund Lookup online, that their ABN registration details have been removed. So that's the ATO suspending the ABN for late lodging funds. So again, in that circumstance I described to you before of the accountant who had the client with a self-managed fund setting up another self-managed fund, his existing self-managed fund, he hasn't lodged a return for 3 years. So the ABN's cancelled. He can't get an ESA because there's no ABN yet, or it's not active, so it doesn't show up, and he can't. If you can't get an ESA, he can't comply with these rollover payment standards. Additionally, as well, his employer can't make superannuation contribution payments through SuperStream because, again, the ESA is the ABN suspended, so the ESA is also suspended. So it's really on us as advisors to, obviously, it's in our interest as well as tax agents. We've got lodgement standards that the ATO sets for us, for our client base. But for clients, particularly clients who are contributing clients, make sure your fund is lodged and up to date and on time. The superannuation system's a pretty generous system. With the tax rate, it's pretty generous. The ATO is reasonably reasonable, obviously, in those circumstances. So getting the fund lodged on time is probably the least we can do, where clients, particularly either partially in pension mode or fully in pension mode, you're not paying any tax. The least you can do is get your return lodged on time. The difficulty I see with late lodging funds that clients often don't appreciate, and some advisors don't perhaps fully understand still, is it's not just as simple as, okay, great, we lodged the tax return today, now our ABN is active. I think the ATO's process is that once a month they sweep through and they update everything. So you could have a 4-week wait if you've lodged something within the last couple of days before your client's ABN is active, and then therefore their ESA becomes active again. So, consider that in light of clients who perhaps you're building up towards tax planning towards the end of the year and they're looking to make concessional contributions. And they can't because they can't comply with SuperStream through their employers. Consider that in light of clients looking to roll money in to a fund that, again, the fund's ABN's cancelled. The sending fund cannot send that rollover. As well, consider that just in light of late lodgement penalties. Consider that in light of pension minimum standards that need to be met. There's a raft of things that sort of need to be addressed, obviously, and late lodging funds, just keep on top of your clients is the best thing that I can say. We had a client of ours who we've been chasing for tax return, signed accounts and signed tax return for about 9 months now. Went to go and open a new bank account and they can't because the ABN doesn't exist. So sometimes you've got to bide your time and wait for the client to actually be forced to be motivated to respond. But the best we can do is encourage them as actively as we can. Again, with some of this stuff, some of the challenges are if we're too far removed, or if you've got some clients who run their own business and they're just used to writing a check to their self-managed fund on the 28th of June and getting it deposited same day. Things like SuperStream aren't probably going to be that front of mind or that big a concern, but it is if they're looking to move money in or out, or they're looking to establish a new bank account or open a new portfolio, or an advisor's got them moving into some different assets. again, we need an active ABN. So that's a change, obviously, that's been in play now for about 4 months, but probably it's had its changes and its applications on rollovers and the rollover system particularly. As I said, Div 293 is impacted as well, but it sort of feels like the way the ATO goes about collecting Div 293 payments is almost an annual sort of change in the way that they go about the process. Really important to, again, just engage with your clients around that, because the ATO needs to send a release authority to the fund. You can't just have, or the client can't just have their fund write a check to the ATO for that amount. They've got to wait for the fund to have the release authority received by the ATO and then follow those standards as well. So doing that or not doing that does potentially give rise to an early release issue if the money's left super without any release authority or otherwise condition of release satisfied by the client. Probably one of the last things I just wanted to go through here was, again, around conditions of release. It constantly, and particularly more so since July 2017, when we had that change in distinction between the transition to retirement funds in accumulation phase versus in retirement phase. I'm just really engaging with your clients around what satisfies a condition of release is really important. I think, again, the superannuation system is a very generous system. There's a lot of tax concessions, even more so for retirees. So being able to properly document and properly satisfy those conditions of release, plan around it, have your documentation provided, produced, and as accurate as possible in as timely a manner as possible is really important. So I think, we've got systems in place now with the ATO that are only going to get more timely in their ability for us. The onus is now on us to leverage and use expertise in a proactive manner, and to use software and providers like BGL in a proactive manner. So I just really wanted to sort of close on that aspect of things. Being able to have those proactive discussions, access things on the tax agent portal, get through items such as planning around pension commencements. Like I said, proactive discussions around needs versus pension needs. A lot of clients do bristle and have nervous reactions when I talk to them about not having all their super in pension mode because they don't need the money, but the side effect is they might actually get a smaller tax refund. It's always amazes me as how hell-bent people are on maximising their tax refund as much as possible. But I think more and more what to expect in 2022 and particularly beyond is our clients are going to expect us to have more timely conversations with them, prepare them better for retirement and through retirement, prepare them better as well, probably in protecting assets and growing wealth through their accumulation phase. A lot of these factors available through things like, the 6-member funds, maximising contributions, catch-up contributions, those sorts of things. And again, that's going to rely on us to rely on providers like BGL and the fantastic job they do in making our job and our life as easy as possible. So just wanted to wrap up there with those comments and those thoughts. Daniel, if there's any questions, happy to take some of those now.
You must have done a really good job because no questions came through.
Excellent, good stuff. Good stuff. Now, look, and as I said, I mean, you guys do a fantastic job at preparing your software as quickly as we can to make our lives as advisors as easy as possible. Obviously, your software is only as good as the garbage that we put in. So it's up to us to get the good stuff in there so that we can get the good stuff back out. But really, as you said before, TAG and BGL has been a long relationship, and always love BGL's proactiveness and thoughts around making our lives as easy as possible.
Thank you. And we've got a great team of people in Matt Crofts, Joanne, Bradley, Anthony Fernandez, Brad Wilkinson Fernandez, and people like James Lau who do great development work, who take this these changes that take place and proactively sort of break them down and then work out ways to implement them in the software. And I think that we're pretty much one of the first in the space, or in most cases, the first to actually implement the changes and have them in our clients' hands.
Yeah.
So that's something that we're really proud of and something that we know that our clients can continue to depend on going forward.
Excellent.
So look, if there's any questions, we will be around for a few minutes. On behalf of BGL, Jason, I'd like to thank you for today. I know you've put a lot of time and effort into today, and the content is always good. And I know that whatever comes out of TAG is of quality, and this was no exception. So I'm sure that the people who attended would really have appreciated the content, the context, and the information that you were able to share with them in a really simple and easy to understand way. So thank you.
No problems as well. Look, if anyone's got any questions and they're too shy, just send it through to team@tagfinancial.com.au. And otherwise, I'm looking forward to seeing you guys at Melbourne at RegTech.
Yeah, should be good. So it's
team@tagfinancial.com.au. So flick it through there. It'll make its way through to me or to Brenda or to Emma, who's the manager in our team. And more than happy to help out. And just again, as I said, it's just about trying to sit at the top, take the technical, make it practical, and present it in a way, hopefully, that your clients, particularly clients, understand. Because if they understand it, they'll appreciate it.
Yeah, look, and I've added the email address to the chat so people can grab it from there.
Good stuff. Beautiful.
Okay, look, it looks like there are no questions coming through. What we'll do is just wrap things up. And Jason, thank you once again on behalf of BGL, and thank you for the great association that we have of TAG Financial Group. They're just an amazing group of people, and we've had a great long relationship with with many of the people there, and it's just been, especially Brenda and Michelle, it's just been outstanding. So look, if you have any questions, they'll be more than happy to take your questions. You can email them through, and based on my experience, I know that they will get back to you and support you if they can. So thank you once again. Thank you to everybody for joining us today. And look, BGL RegTech will be going ahead. And we've got all the details available for that. That's coming out on many of our communications and socials. I've put the link into the chat. And we're going to be in Sydney on the 1st of March, Brisbane on the 2nd of March. The 9th of March, we will be in Adelaide. And then on the 16th, we will be in Melbourne. So if you can get there, we'd love to see you there. In WA, we will be hosting the live stream event from Melbourne on the 16th. So unfortunately, we can't get there, but otherwise we'd love to be there too, but circumstances don't allow us to. So thank you once again for all joining us. We look forward to seeing you soon. And once again, Jason, thank you.
Cool. Thanks, Daniel. Thanks all.
See you.
Ta.